We have officially crossed the line most investors never see until it is in the rearview mirror. For years, we warned that the silver market was not just cheap, but structurally rigged. The tamp down was not a theory, it was a mechanism. Spot was held down by leverage paper derivatives and the bet that nobody would stand for delivery all at once. Now that gamble has failed. This is not a rally, it is not hype. It is not optimism, it is a rupture. Silver didn't move up in an orderly fashion, it didn't climb, it went vertical. A double-digit percentage move in one session is not how real markets behave. Metals do not rise 10% in a day under normal conditions. That sort of movement only happens when something snaps beneath the surface. When forced buyers replace willing ones, when survival replaces strategy, when the COMEX stops negotiating and starts liquidating positions immediately. Somewhere a massive naked short reached its breaking point. Margin calls went out, collateral failed, and the clearinghouse took over, turning risk control into a blind bot with one instruction: cover at any price immediately. In thin liquidity with no seller stepping in, price didn't travel. It teleported. That vertical candle on the chart is not bullish enthusiasm, it is the footprint of a default. This is why this moment matters. Because once forced covering enters the pit, true price discovery changes forever. The old rules stop applying. Resistance lines become irrelevant. Bank analysts arguing fair value are left behind. What remains is urgency. Fear on one side, disbelief on the other, and a rapidly shrinking stack of physical silver sitting right in between. We are standing at the edge of a new era, not just for silver, but for faith in the paper pricing scheme that priced it. This chapter is the opening bell, not the climax. And if you are watching this now, you are early to the truth, even if the spot price no longer feels early. The event horizon has been crossed. There is absolutely no rewind button. If this intel resonates with you, press 1 in the comments to confirm you are still stacking, and subscribe so you don't miss what comes next. This silver squeeze is just beginning. To understand why this move was so violent, you have to see what forced buying looks like inside the machinery of the broken paper scam. In a normal market, price is found through negotiation. Buyers wait. Sellers hesitate. Liquidity forms a bridge between opinions. But in a liquidation event, that bridge collapses. The market stops being a conversation and becomes a crowded single emergency exit route. When a leveraged fund fails, control is taken away from human decision makers. The clearing system steps in and executes without judgment, without patience, and without regard for the price. The goal is not profit, it is containment. Naked shorts must be closed immediately to prevent losses from spreading further out. This is where price loses its meaning and raw speed replaces logic. What we saw was the order book being consumed in real time. Every sell order was lifted not because someone believed silver was cheap, but because someone had no choice. Volume surged, not as confirmation of optimism, but as evidence of stress. This is the mark of a short squeeze moving from theory to systemic. Retail shorts go first, then family offices, and eventually institutional funds with balance sheets big enough to distort markets when they fail. This is the moment dominoes stop falling one by one and start collapsing in clusters. Because large shorts are not isolated bets. They are embedded in portfolios hedged against other plays and tied to credit lines. When one leg breaks, the strain transfers across the structure. That is why a 10% move in silver is not about silver. It is about the stability of the scheme that allowed that position to exist in the first place. At this stage, sellers disappear, not because they want higher premiums, but because they don't trust settlement. When counterparty risk enters the equation, paper claims lose credibility. The fear is no longer missing upside. The fear is not getting paid. And once that fear spreads, liquidity vanishes faster than any high-frequency bot can replace it. This is how localized stress becomes systemic pressure. Not through news, but through margin calls, collateral gaps, and forced execution. The market is no longer pricing fair market value. It is pricing survival. And that shift is absolutely irreversible once it begins. Now we need to zoom out because silver never moves alone. It has a shadow, and that shadow is gold. Gold is the anchor of the real money complex, the signal that tells you whether a move is speculative noise or a structural reset. And right now, gold is not whispering. it is confirming. Gold holding extreme levels is not a fluke. Historically, gold leads, silver follows, and then silver accelerates. When gold establishes a new floor, it gives algos and institutions a reference point. They don't ask whether silver should move, they ask how far behind it is. That gap is where the chase begins. The gold-to-silver ratio is the oldest valuation tool in the sector. When fear rises and fiat weakens, that ratio compresses. Capital rotates from the larger, more stable metal into the smaller, tighter one with higher beta. That rotation is mechanical, not emotional. Models trigger. Funds rebalance. Momentum strategies activate. Silver becomes the expression of the same macro stress amplified greatly. This is why vertical charts feel unnatural. For years, silver was tamed to move slowly, capped by paper supply and managed volatility. That conditioning trained stackers to distrust sharp advances. But once gold validates the move, that conditioning breaks. The suppression phase ends, and the catch-up run finally begins to play out. This catch-up is potent because it is fueled by math, not opinion. If gold reprices, first silver must follow to restore the ratio. And the longer silver lags, the more aggressive the eventual move becomes. That is what we are seeing now. Not exuberance, but the massive coiled spring finally releasing. What makes this moment dangerous for skeptics is that silver still looks cheap relative to gold even after a historic day. That view invites capital at the worst possible time for those betting against the metal. It pulls in algos designed to exploit ratio dislocations and forces late shorts into truly impossible decisions. This is the pivot point from disbelief to recognition, from denial to momentum. Gold has spoken, and silver is responding, not politely, not gradually, but happening all at once. While price action unfolds on the screen, the real stress builds where most investors never look: the physical market. This is where paper narratives collapse because metal cannot be printed, rehypothecated, or delayed without consequence. When price moves faster than logistics, the illusion of plenty disappears. As silver surged, bullion dealers didn't raise premiums. Many simply stopped selling. Sold-out site maintenance call for pricing. These are not marketing tactics, they are warning signals. When volatility exceeds software limits, dealers step back because quoting a price becomes a liability. If metal gaps higher overnight, every posted price becomes a massive net loss. This is how a paper spike transforms into a physical shortage. The screen price freezes while the street price runs. Coins, bars, and industrial supply begin trading at levels disconnected from official quotes. At that point, spot price becomes theoretical. What matters is availability. Can you get the metal at all? And if so, how much are you willing to pay? This is the definition of a currency crisis. When goods cannot be purchased at the official price, the fiat used to price them is no longer trusted. People don't ask what silver costs, they ask whether it exists. And that question alone shifts behavior across the entire financial system. Industrial buyers feel this first. They don't speculate, they consume. When supply becomes uncertain, cost becomes secondary. Contracts include force majeure clauses, and in extreme volatility, those clauses get activated. Deliveries are delayed. Shipments are renegotiated. Manufacturers are forced into the open market to compete with stackers for the exact same ounces. This is where panic buying begins, not driven by greed, but by necessity. When industry enters the spot market, it removes supply permanently. That silver doesn't return to vaults. It becomes product infrastructure technology. Once consumed, it is gone forever. This is why vertical price moves don't resolve quickly. The metal is leaving the system while demand accelerates, and no chart can model that movement in advance. Now we need to discuss what happens when this stress collides with the rules of the exchange itself. Futures markets are built on the assumption of orderly movement. To protect the rig, exchanges install circuit breakers, daily price limits, designed to slow things down when volatility becomes extreme. But these safeguards are not solutions. They are pressure valves. And when pressure keeps building, freezing, the market doesn't remove risk. It concentrates it. With silver already sitting near historic thresholds, even a modest gap higher at the open is enough to trigger a limit event. When that happens, trading halts. No buying, no selling, just a frozen screen. For long-term stackers, this feels validating. For anyone short, it is pure terror. Losses continue to grow, but there is no exit. Time becomes the only enemy. This is exactly how panic spirals. Halting the paper market doesn't calm anyone, it traps them. The naked shorts know that when the casino reopens, spot gaps up. This forces them to cue panic buys for the open, ignoring the premiums. These covers ignite the exact squeeze they dread. It's a self-feeding death loop, and once the tamp fails, the explosion feeds on itself. We've seen this play out in smaller rigs: nickel, lumber, energy. Each time the endgame was identical. Liquidity dried up, faith died, and true price discovery reset at levels the algos never modeled. But silver is bigger, more vital, and more politically charged than any of those sectors. That means the fallout here is vastly amplified. This isn't a market for paper leverage. Volatility of this scale wipes out margin accounts even if the ape is right on direction. A $5 rip becomes routine. A $10 smash becomes possible. Survival favors those who hold physical stacks and can simply wait it out now. The COMEX can slow the ticker, but it cannot print metal. And as long as stacking drains deliverable supply, every halt just delays the inevitable repricing higher. The paper scheme is straining, and the limits are no longer a ceiling. They are a loud signal that the rig is losing control here. At this point, attention shifts from traders to institutions because whales move markets when they are forced to react, not when they plan to. For months, large funds expected to enter silver later. They penciled in allocations for the new year. They assumed time was on their side. That naive assumption has just collapsed now. Institutional fiat is not patient capital. It is benchmarked, ranked, and constantly compared. When the shiny moves 10% in a single day, it stops being ignored and starts being chased. Performance pressure takes over. Funds that are underweight silver suddenly face a career risk. Not stacking it becomes far more dangerous than buying it late. This is why sharp moves attract capital instead of repelling it. A violent breakout signals opportunity to momentum-driven strategies. The algos don't ask whether spot is high, they ask whether it is accelerating. And acceleration is exactly what a forced liquidation produces truly. As these funds step in, they don't nibble. They buy in size and they buy regardless of short-term tampdowns. Their entry compresses supply further because they aren't trading paper in and out. They are reallocating fiat. Once that capital enters, it stays put until a new equilibrium forms here. But this is also where turbulence really increases. Early stackers begin to see gains that feel unreal. Profit-taking emerges. Pullbacks become sharp and emotional. A $5 drop feels catastrophic to someone who just arrived, even though it is meaningless in a vertical market. This is where weak hands exit and diamond hands absorb. The key distinction here is trend versus noise. In a repricing phase, corrections aren't reversals, they are pressure releases. Each dip transfers metal from impatient paper hands to stackers with longer time horizons. That process strengthens the trend rather than weakening it now. This is why discipline matters now more than ever. Emotional trades are expensive. Overconfidence is punished. Fear is punished faster. The market is no longer forgiving because the rig is no longer balanced. It is fully transitioning. The institutions are waking up, and when they move, they don't tiptoe. They reshape the whole landscape. When markets move this violently without a single clear headline, it usually means the headline hasn't reached the public yet. Spot moves first. Information follows. This is one of the oldest rules in financial markets, and it is especially true in commodities tied to geopolitics, industry, and true sovereign interests. A sudden 10% rip is the market signaling that something is breaking behind the scenes. It could be stress inside a financial institution. It could be a COMEX settlement failure. It could be an interruption in supply that hasn't been formally announced. Whatever the cause, someone with better information is acting, and they are acting with urgency. This creates information asymmetry. Insiders position themselves quietly while the public debates narratives. By the time confirmation arrives in the news cycle, the spot price has already adjusted. That is why waiting for certainty is so costly. Certainty always comes at a higher price now. At this stage, rumor itself becomes fuel. Whispers about counterparty failures, delivery defaults, or emergency meetings don't need to be proven to affect behavior. They change incentives. Sellers hesitate. Stackers accelerate, trust erodes. In markets built on confidence that erosion is enough now. This is also where global dynamics matter. Silver is not priced by one country. When stress appears in one region, capital shifts through time zones. Asia reacts to New York. Europe reacts to Asia. Each session inherits the anxiety of the previous one and adds its own urgency. Massive price gaps replace intraday movement. The market no longer sleeps. This is how localized disruption becomes global repricing, not through a single event, but through cascading reactions across regions that no longer trust the same assumptions. And once that cascade begins, there is no central authority capable of reversing it quickly now. The market is telling us that something significant is unfolding. The spot price is the message. Everything else is noise. As the financial system reacts, industry does not wait for explanations. It acts. This is where silver's unique role becomes impossible to ignore because, unlike many assets, silver is not optional. It is embedded in production. Energy electronics, defense, medical technology. When physical availability is questioned, procurement behavior changes instantly. Industrial buyers are not speculators. They don't debate charts or ratios. They manage continuity. A factory that cannot secure inputs does not slow down gracefully. It stops. That risk is existential. So when price volatility signals potential shortages, cost becomes secondary to certainty. Paying more is preferable to not receiving real metal at all. This is how off-market transactions emerge. Long-term contracts are renegotiated. Suppliers invoke clauses. Buyers bypass public exchanges entirely and strike private deals directly with producers. Metal that once flowed into transparent markets disappears into closed supply chains. From that moment on, it is no longer part of available inventory. It is fully spoken for. This privatization of supply is invisible on price charts until it suddenly isn't. Official production numbers may look stable, but deliverable supply collapses. Vault inventories drain. ETFs struggle to source metal. Futures contracts settle in cash instead of ounces. Confidence in paper exposure erodes even further. At the same time, the public begins to wake up. Not because of fundamentals, but because of movement. Sharp price action captures attention in a way years of analysis never could. Searches spike. Retail orders queue up while markets are closed. Demand stacks quietly waiting for the very next open. This is where scarcity accelerates. Industrial demand removes supply permanently. Retail demand removes liquidity unpredictably. Institutional demand removes flexibility, and none of them coordinate. They simply react to the same flashing signal. The system was built to handle one of these forces at a time, not all of them together. That is why stress multiplies instead of dissipating. The metal is being pulled from every direction, and truly nothing is replacing it fast enough. When pressure builds across financial, industrial, and retail channels simultaneously, the weakest link is always the intermediary. Futures markets are zero-sum systems. For every winner, there is a loser. And when price moves violently, those losses do not stay contained. They concentrate fast. The scale of this move tells us the losing side is not retail. Small traders cannot absorb multi-dollar swings. They are eliminated early. To withstand this kind of damage and still function requires balance sheets measured in billions. That points directly to systemically important institutions. The same entities responsible for providing liquidity are the ones now under deep strain. When a clearing member fails to meet a margin call, the exchange steps in. It seizes collateral, liquidates positions, and attempts to contain the damage. But containment has limits. If losses exceed posted collateral, the exchange draws from its default fund a pool financed by other members. Losses spread laterally then. This is contagion. One failure weakens others. Liquidity is withdrawn. Trust erodes. Banks begin to question each other's exposure. Lending tightens. Stress leaks into unrelated markets, bonds, funding rates, credit spreads. What began as a metals trade becomes a massive balance sheet problem. This is why central banks eventually appear. Not to save silver traders, but to stabilize the plumbing of the system. And stabilization always requires liquidity. New liquidity dilutes currency. Diluted currency pushes hard assets higher. It is a self-reinforcing trap now. Attempts to suppress price to protect institutions backfire because they signal weakness. Every intervention confirms scarcity. Every reassurance accelerates demand. Confidence cannot be restored by decree once it has fully cracked. This is the stage where markets stop reacting to policy and start forcing it. The metal is no longer a trade. It is a verdict on fiat trust. This is where strategy replaces emotion. In a vertical repricing phase, the real risk is not volatility, but poor decisions made under pressure. The goal is no longer to chase price, but to understand the cycle and act with discipline now. Silver price action isn't speculation. It's a flee